Hello, everybody. It's been a while. It's been a long time. Markets have been very active lately, especially the crypto markets. But thank you to my loyal subscribers that have been following me, that have followed me on Discord. I am very active on there. You can click the link below to join up. But I figured I'm way overdue for another video. So here we are. Welcome to my channel, The Financial Trader's Mindset. And in this video, what we're going to talk about is how can you profit out of a sideways crypto market, right? You know, like normally in crypto, we're always looking for the price to just go up, right? There's no other way to really profit from volatility, from sideways market action. There's no real way to really hedge your position, right? There are some ways, but it's either very expensive or not very liquid. So what can you do in a market that's trading sideways? As you can see, we're going to take Link, for example. And Link, ever since November, has been trading sideways. Anybody that has bought around $14, $15 on Chainlink has not gotten any profits up to now, which now we're in January. So over 2 months of just sideways action, waiting for the market to eventually break out to the upside, right? And appreciate in value. So a lot of traders, especially short-term traders, they're not looking to sit in a position that long. You get, crypto is very volatile. It has huge swings. I mean, here you could see 20 to 30% swings up and down, right? So eventually you get tired of the volatility. You're not making any profit. So you just close out the position and look for another opportunity, right? Well, what if you're the person that wants to hodl and hold Chainlink? You are not going to sell, but you would like to earn some income in the meantime during this chop. So what can you do? Well, I'm going to show you here. So I jumped into a Chainlink position right around here near the top, as you can see. So I set up a liquidity pool using Uniswap V3 to farm the liquidity and generate yield off of Chainlink. Now, you're probably wondering, well, wow, why would you set up a position way up here after the market has went up so high? Won't you be in a loss if the price draws down? Yes, you can. But if you're the person that's looking to hold and hodl Chainlink, then this could be a great option. And here I'm going to explain why. So I've been farming this for over a month, starting in December, farming this volatility. And I've seen anywhere from 90% APR in yield up to over 500, 600, even 700% APR on Chainlink. Now, if you have the long time frame in mind, you can see how that can just compound and grow over time. And you don't necessarily have to wait for Chainlink to move to the upside to profit. You can profit from this volatility. And here's APY Vision that you can see on the screen showing my exact position, right? Now, this is my current position that's only 3 days old, right? I've been farming it for a month, but I've been rebalancing, rearranging my ranges. That's why I've seen anywhere from 90% APR, which is a very wide range, to now where I'm getting 463% APR on a fairly tight range, right? So I'm going to switch this to Link, and you could see the price range here is from $13.47 to $15.65. You can see I deposited $94,114. Now, when I started farming this in December, I started with a stake of $110,000. So this is obviously down about $16,000, right? But over the past month, I've generated over $10,000 in yield, right? This yield here is yield that I've earned only in the past 3 days. And that's because I'm in a fairly tight pool. But on average, over the past month, I've generated a total of maybe 10, 11, maybe $12,000. I haven't done the exact calculations. If you follow my Twitter account, I will post a trade recap on this, showing all the positions, how it performed, and a full breakdown on it. So I'm just waiting to finally finish up this trade. Whenever that happens, that could be tomorrow, that could be a couple months from now, right? So it depends, right? It depends how long this trade lasts. So the idea here was to generate yield. Now, what I did was I staked the liquidity, single-sided, completely in USDC. And I'll show you in the chart here. I started out at $16 or $16.62, I believe. As price went down, my liquidity was exchanged from USDC to Link. So as price was going down, I was gaining more Link. Eventually we got down to like 1261, and my initial range was about, I believe, 1580 to 1660, if I'm not mistaken, if I remember correctly. So as you can see, obviously I had to rebalance and rearrange. Now the key here is to understand and track your original initial stake price, which was 1662 in this case. So that's like my anchor and what I need to track in order to keep in mind, if price gets back to that level, how much will my liquidity pool be worth when it gets back there? Am I okay with the value if it goes back there and it's less than what I started with, or if it's more than what I started with, right? So that is what is called impermanent loss. And impermanent loss is not a bad thing. Impermanent loss is more of, it's a tool to use in order to mitigate risk, right? If I was to lock in more impermanent loss, that means I was expecting more downside, which would protect me a little bit better than being more aggressive, right? So it's it's a trade-off, and everything in the market is a trade-off. You're trading something to gain something, right? So keep that in mind. So the idea with me was that I'm farming starting the top of this range, and this thing has been sideways, right? So I want to farm the volatility here. I want to earn yield over time, but there will be times where I would need to rebalance. But in the meantime, I would need to track where I initially staked, which was 1662. So if price gets close to there, I want to be relatively close in the liquidity pool, right? I want the value of my pool, right? This 94,000. I wanted to be as close to $110,000 as possible. That would mean that I've locked in very little impermanent loss, or even if it's in a gain, I call that an impermanent gain. That means I'm doing really well in managing the liquidity pool, right? That means I didn't take too much of a loss upon the rebalancing, and I tracked my positions in order to gain back that loss should price get back to that level, right? So with that in mind, in addition to that, you can have tight liquidity pool ranges in the meantime, and understand that when price breaks above certain ranges on a smaller time frame, you can rebalance and take action to make sure you don't lose out on a breakout, right? Like if price were to break out and move back to your original stake price, I don't want to be stuck losing too much on this, right? All right. So currently, like, I'm down 16,000, but the plan here is to be break even on the liquidity pool without the yield when we get back to that price. I hope I made sense there, right? So over that course of the month, I've been just farming the volatility, right? And now for me, if I was hodling Chainlink, I'd be really, I just kind of get impatient, right? I'd be like, man, when is this thing going to break out? Ethereum's moving up, Bitcoin's moving up. A lot of people are just impatient, right? And they'll end up selling out, especially in crypto, right? Like, not many people like to hold for a long period of time. So over time, right, the yields should overcome a hodling position, right? So take this for example, right? In the past 3 days, I've earned $3,587. This particular pool 3 days ago, I staked it at a price of $13.49, right? Current price is actually $15.06, right? It's moved up $2. Now, you would think that, okay, it's moved up $2. So in 3 days, probably a hodler that wasn't providing liquidity would probably beat out a liquidity provider, because liquidity provider has impermanent loss working against them, right? As price goes up, you start selling off the asset, so you have less of it on the way up. Whereas a hodler is just holding the entire bag, right, on the way up. So they can realize that entire gain. But in 3 days, right, earning an average of 463% APR, I've generated enough yield to overcome that impermanent loss, right? So the impermanent loss that I've gained, or that I have in the liquidity pool, was $3,197. That just means that someone that hodled the same position and didn't provide liquidity would have $3,197 more than I would, but that's without the yield. With the yield, if you come over here to the liquidity pool gains, I've actually earned $390 more than a hodler, right? Now, say if price were to mean revert back down to $13, right? We'd probably be break even, right? Like say it gets back to $13.49 where I originally staked, and the value of my pool, not the yield, not counting the yield, but just the pool, was to get back down to 94,000, because the current value of this pool, 100,790, right? That's without yield. So if we get back down to this value, right, my impermanent loss compared to a hodler would be flat, because we would be back to no profit, right? We would just be break even. But say if that happens over the course of the next 3 or 4 days, and I earn an extra $4,000 in yield, well, now my profits are way higher than a hodler, right? Where I would be in the $7,000, $8,000 range of just yield earned and generated. And you can see how you can just farm that volatility over time and have the mindset of a liquidity provider, right? Which is different than a trader. You're providing a service to traders, and you're just selling the volatility, right? You're identifying, this is a time that the market may be volatile. I want to earn some yield on my assets. So you put your assets up for trade, right? For sell. So people trade them and swap them, right? And that's how you earn your yield. And you can see how that can really ramp up over time. Now, say if Link were to, just saying that it's probably not going to happen, but if Link just stayed volatile for another 6 months between $15 and $13, if in 3 days I've earned $3,500 or $3,600, right? Imagine in 60 days, right? We're looking at, in 30 days, you're probably looking at $30,000, right? $40,000 in just yield alone. 60 days, $80,000, right? That's pretty impressive, right? And that's a lot of yield. And $80,000 in 2 months, the amount I invested was $94,000. I've pretty much almost ROI'd on my entire position. Now, if you take that and think about it, like I started out farming this at $16.62. Current price is $15, right? I've earned about $12,000 in yield. The current value of my liquidity pool is $100,000, right? Almost $101,000. I started with $110,000. With the yield I've earned, I'm in profit as of today, even though price is at $15. $1.60 lower than where I started providing liquidity. Now, a lot of new liquidity providers, they would get freaked out, right? If they start farming up here and prices like going against them, they eventually freak out. They see the value of their pool going down. They're like, oh my God, it's not working. But they're not thinking about the long game, the volatility game, time in the market. That's the idea, right? And over time, what you're doing is consistently 24/7, 365, because crypto trades all the time. Every second of the day, you're earning yield. You're reducing your cost basis over time. In 2 months, in 3 months, at a 400 and 500% APR, I could reduce that cost basis to zero, right? Link could go to zero after that, and I would be break even, right? Now that's the way you got to think. Like, how can I reduce the cost basis of a position? With that mindset, you don't care if price goes up, if it continues to go up, right? So a question that I usually get before I end this video is that, well, what if price were to keep going up? Well, in this market, I've set up what I did was I'm long Ethereum and I borrowed against it. So what that does is that I borrowed USDC against it. So what that does is it allows me to stay long the market, long Ethereum, and generate extra yield on top of that long position. So it's kind of a leverage. It is a leverage trade, right? So using that capital, that loan, to farm yields on top of my long position, not only am I earning yield, but I'm also staying 100% long the market as a hodler, right? And earning yield on top of that, right? So it's a more aggressive position, yes. So it should only be done in specific type of markets, like a current market where it's been rallying, right? But you kind of get the idea of like how you can utilize concentrated liquidity to continuously generate yields over time and just add more and bring down your cost basis over the course of your trading journey, right? So I hope that was helpful. If you have any questions, please leave them in the comments below. I appreciate you guys for your support, especially those in the Discord. If you have any questions, please join my Discord if you're not in there. I'm in there every day. Feel free to ask questions. It's free to join. So just join up, ask questions, especially on this video if you have questions on it, right? Because, this is an opportunity it's here, right? And just not many people understand how to use concentrated liquidity, right? And this is just real yield. It's paid out in Link and USDC in this position, right? If this was Ethereum USDC, it would be paid out in Ethereum and USDC, right? It's no tokenomic no Ponzi-nomics, no incentive token. There's none of that. It's all organic yield. It's made by real organic volume. When people trade on Uniswap, you get paid a fee, and that's the fee that you get paid right there, right? So, this opportunity just is not going to last forever, right? Eventually, liquidity is going to increase. It's going to flood in, and then these yields will get diluted over time. I mean, I'm not saying it's going to happen, over the course of 6 months, maybe a couple of years, but, how much can you earn in those couple of years, right? And I truly believe that, the biggest opportunities in markets are when there are inefficiencies, when there's lack of liquidity, when not many market participants are involved, right? That creates inefficiencies in the market, which creates big opportunities. Kind of like the brokers in the 80s, right? In the 70s, right? They used to profit off of a spread in a market. And spreads were very wide back then because there was lack of liquidity. So they would make cash hand over fist for doing practically nothing, just facilitating trades to people, right? They would facilitate the trade and they earn that commission on the spread. And that's where the money was made because that was an inefficient market. But today, the stock market is very liquid. A lot of those inefficiencies are gone, right? And it's very hard to find an edge in a very efficient market, right? So, you know, even though the crypto markets may be scary, they may be volatile, but that's where the biggest opportunities are. As you can see, and if you follow my Twitter account, you can see countless examples of this, what I posted. I will have a full trade recap on this when this is done. And yeah, I appreciate your support. Thank you again. And leave a comment below, like and subscribe. I'll see you guys in the next one. Thanks.